Understanding diversification. Every investor is familiar with the idea of diversification. Diversification is a way of minimizing portfolio risk by owning a variety of investments with a low correlation to each other. While diversification doesn't eliminate the possibility of suffering a loss, it's an important part of attaining longer-range goals. There are two principal types of risk found in equity investments. Systematic risk is the risk found within the total market. In fact, it's often referred to as market risk. This is the uncertainty or volatility in the entire market. A few sources of systematic risk include recession, interest rates, and political instability. These are risk factors that can't be addressed by diversification because they affect the entire market. Systematic risk is also called undiversifiable risk. Unsystematic risk is the risk within a company or industry. This type of risk is limited to a specific company or industry. Most of this risk is a function of financial risk and business risk. Unsystematic risk is also called diversifiable risk. Diversification is a strategy for reducing unsystematic risk. This is accomplished by spreading your investing dollars over a wide range of investments with low correlation. Not only can your risk be lower than the weighted average of your investments, it's possible to have a risk level that's lower than your least risky investment. You're probably familiar with the saying, "Don't put all of your eggs in one basket." This is a simple and accurate example of diversification. By placing 10 eggs in 10 separate baskets, you're much less likely to lose all your eggs, but you're more likely to lose one. If you invest in only one stock, there's a relatively high possibility of earning or losing a lot of money. By investing in multiple stocks, your results will be less dramatic. You can always expect to earn better returns than your worst performing stock. Purchase enough stocks and your returns will match the return of the overall market. There's one problem. Introducing a high level of diversity into your portfolio on your own can be expensive. All the transaction fees can seriously lower your returns. That's the beauty of an index fund. The transaction fees are spread over thousands, even millions of investors. Index funds offer a high degree of diversification at a low cost.